here we have the fun of talking about what is happening in the U.S. and the demand keeps getting a bit worse when you look at, and a lot of this is being driven by the economic side. And when you're looking at the economic drivers, and we're going to talk a bit about that for a minute in the FSC show, because that's where we see a lot of this downside pressure when you look at what shipping companies are saying, which are really confirming all of the data we've been showing you for the last few times, really. So the current, this past week, the current demand was at 13.84 million. Last week was 14.66. So again, you had almost a million barrel a day drop. We still think that holds right around that 14.5, 14.6 level on the 4-week rolling average. But it's going to be interesting to see what this week and next week show, because obviously everybody's driving. It's just the question is how much less are they driving than normal, and then what does that makeup number look like? Because when you look at the data for gasoline, it's a little on the low side. I would say that are we at actually 8.3 million? I'm going to say no. It's probably something closer to about 8.4, 8.5, people trying to get everything done ahead of this week, and then a fairly sizable amount of people driving this week. But then how many people left last week? So it could also be a little bit more drawn out, but we will get a makeup number. It'll likely push closer to about 8.8, 8.9 before it levels off at what we think is going to be about 8.6 million barrels a day on the gasoline side. But then on the diesel front, we continue to see those headwinds. Now, distillate stock, you can see that there was a build of 1.72 million. That's 16.4 million below the 5-year. But there were builds pretty much across the board, with the largest being in Pad 1 with an increase of 1.36 million. And that's driven by a lot of products showing up on the East Coast. Specifically through the Colonial Pipeline, there were over allotments. A lot of distillate was pushed through. You had a Jones Act vessel show up. You had 2 other vessels show up. So you had a fairly sizable surge between last week and this week. Imports, you can see, are down slightly, but again, a lot of that is timing delay because we did get a decent move. But even with that, you can see we're still well below normal in the East Coast, and the focus is going to be, what does weather do? If the weather gets a bit worse, that could draw down, especially in Pad 1A and B, when you look at New England and the tri-state area. But then realistically, diesel demand on the road side is going to see more weakness, or at least stay at a very weak level. Even though we're in the holiday season, we're just not going to see shipping in the same way, and you're going to see things be a little bit slower, which is when you start looking at diesel cracks. Like the crack spread, it came down just a bit. It's not a huge shift, but like we said, it's closer to about 61 as we showed in segment 1. And that's, again, we think that there's staying power here, just given where storage is. You have to incentivize those movements so that it'll support pricing, but things have gotten a bit softer. And in the US, we should still see crack spreads be supportive, but abroad, that can change fairly quickly, especially when you look at Asia, where we're starting to see an issue, a continuous issue on the gasoline front. And as that gets cheaper, if not negative on the crack side, there's going to be more and more reliance on distillate to carry that forward, which is why we do think that you're going to get a sizable cut, or at least a meaningful cut, in official selling prices coming out of the Middle East due to the difficulty they have of clearing that. Pad 1, you can see we had a build, but look at the historics. There's typically a bit of a build here. So the question is going to be, what is the rate of change? How quickly are we building? And if we're not building at a fast enough rate, we're going to be in a problematic spot, especially when you look at the East Coast heading into winter. While Pad 3 is very normal, and that's the biggest concern right now, because how do you get product, or biggest hindrance right now, how do you get product from Pad 3, where there's more than enough, to Pad 1? And the options are the Colonial Pipelines, line 1 and 2, rail based on what rail is, and then obviously Jones Act vessels because you're going from a U.S. port to a U.S. port, which is why we based on these numbers, we should see exports remain fairly elevated on the distillate side moving into the global market. Here you can see diesel demand or distillate demand in general is well below normal. There'll be a spike. Typically, obviously, this is lumpy. People will be in their homes. They'll want to keep all their guests warm. There's usually that spike, which you can see here, and then a fairly sizable drop off. So realistically, on a mark-to-market level, we should get back to about the 5-year average on the spike, but it will likely be another lower high, just given where demand is. We have a little bit of a warm up coming, not a huge warm up, but again, we're not going to have 40s again, at least on the East Coast. It'll be something a bit close, a little bit above normal. So here, when you look at the trucking market, this is just looking at market demand. You've had a bit of a flat line. But as we've shown with FreightWaves data and some of the commentary that they've had that we've discussed in both the EIA show and the Econ show, we see a lot of overhang there. And again, that's just it's going to put a big damper on diesel demand when you look at the trucking front. And the question then turns to, well, how much can heating oil protect us? And that's going to be very spotty there. And that's where you're going to get some fairly sizable arbitrage opportunities between Pad 1 as well, or I should say New York Harbor and Houston. Then when we look at rail traffic, you can see that there was a bit of a slowdown. Petroleum products still remaining elevated, grains elevated. The intermodal side is going to be the one to watch. There's a bit of a slowdown as we head into Thanksgiving. We do think that'll pick back up, and you'll see total traffic be slightly below where we were last year, which is, it should keep things fairly normal, if you will, when we look at underlying traffic and shipments. Now, more pressure on the Port of Los Angeles side. When you look further out, we actually, and this is estimations on products coming in, we're actually not going to have a big offshore backlog. And this is going to be the first time really since 2019 that we're not going to have a backlog of ships on the water, where if you remember, there was a bunch of boats that were just loitering, waiting in order to make their way into the port because there was such a backlog. That has now cleared, and if anything, it's going to continue to worsen as we've been highlighting, which is also, again, going to put pressure not only on marine gas oil demand, but also shows that there's more downside to the trucking front, and XPO Logistics was the most recent to comment on it. Now, when we look at some of that warm-up I was discussing, here you can see that things are going to be slightly above normal and across the Midwest into the Mid-Atlantic South. But the Northeast is going to be near normal. So you're going to have some decent consumption, or at least normal consumption of both heating oil and natural gas. As things actually get much colder, when you look from essentially the Rockies west and all across the north, which is going to increase or at least support additional consumption of both heating oil, propane, and natural gas. So this should see a bit of a balance out. So again, you should get based on this data sets and where the consumption patterns are, this should be slightly supportive of natural gas and heating oil consumption. Gasoline had a big build of 3.06 million. Again, that's 8.3 million below the 5-year, but that's all driven by Pad 1. So Pad 1 had a draw of 2.18 million. But everything else is either normal or slightly above normal given those levels. So it's really Pad 1, and it's the arbitrage being closed between Europe and the U.S. that is keeping those barrels or the gasoline barrels stuck in the European markets and not flowing this way. As we said last week, there's typically a big spike in gasoline storage. It either starts this week or next week. It started this week, and then we'll have a fairly sizable build just because refiners are going to target distillate and diesel, and that naturally throws off gasoline. They're going to be building up their gasoline storage into summer. So again, this is fairly normal. It's just we think it's going to happen at a faster rate of change, which will put us a bit higher as we get into December. with imports fairly flat. Again, it's going to be sporadic in terms of when the arb opens up, but we don't see that opening in a big way. So it's really going to come down to slowing demand and additional diesel production. Blending components had a build of 2.33 million. So when you look at it, it's only 2.4 million below the 5-year average. So as we were saying, blending components were going to catch up much faster. And it's because there's been a big slowdown in the petrochemical side. So a lot of the products that can go into either will likely get dumped into the blending pool or the gasoline pool. And that's what we're seeing here. And we don't see that changing. So we do see a fairly accelerated pace of builds in blending components. It'll likely drop first just because you normally, when you get a big backlog like we do for for Thanksgiving, that you'll get a little bit of a down move. But then, through December, really, we should see a fairly sizable build into year end. Then when you look at the data coming into this week, you could see here that there was a big spike in Europe. Things slowed down a bit in Asia, and North America fairly flat. But China weakened considerably, and you can see that it keeps getting softer and softer, and that's something that we think continues because you have a mixture of this unknown with the different levels of, what is the slowdown going to do? Are we going to get zero COVID? The zero COVID policy, a loosening of it. And there's so much uncertainty. COVID is exploding across the country, which is normal for anyone who experienced Omicron and some of the other more contagious versions. So that's, I think, fairly standard. And then when you look at the TomTom congestion index for China, it's getting weaker, and we think that that's going to progress into the rest of the year. Prices rolled over for gasoline, so now we're down to $3 and just under $3.61. So now we're below that high, that low point that we had in September. It's a positive move. But even though we've gotten a big rollover in gasoline, diesel is still sticky. So we're still right at just under $5.27. Just given where we are in the storage side, on the diesel demand side, the heating oil side, there's some staying power right now at about this price. If anything, there could be some additional softness of about 4 to 6 cents. But there's some of that stickiness when you get to about $5.20. So again, you're going to still see that remain elevated. When you look at gasoline demand, fairly sizable drop off. I think realistically, you have to put this into context of when did the shipments show up? When does the move from the racks to the retail happen? So that's, again, put a little bit of a hamper on it. We do think that will be a bit of a bounce. It's just going to be a question of how big is the bounce, and we think it'll likely be muted. And if anything, spread across both this week and next. So that's also going to kind of slow down the amount that were higher. And that's why when we talk about that 4-week rolling average, we still see it at about 8.6 million barrels a day. When you look at Google mobility, you can see here workplace still remains the overhang. We don't see that changing. There will be that bigger drop off, obviously, for Thanksgiving as people don't work, mostly Thursday and Friday. And then things will remain. When they snap back, they never really snap back to normal of pre-Thanksgiving, just because you then start the holidays. Some people take longer vacations in December, and December starts that slowdown into year end. Propylene had another build of 1.21 million. That's 7.8 million above the 5-year, continuing to grow and having actually a counter-seasonal build. And a lot of this is driven by an increase in production and a fairly sizable drop in local demand based on the slowdown in petrochemicals, which will be the overhang. Jet fuel, small builds of 300,000 barrels. And as we said, it's right in line with what our expectations are. So not too much to talk about here. Passenger, you can see, we're getting that normal kind of little bit of a lull, and then you get the big spike for travel. It's usually Tuesday, Wednesday, and then again on Sunday. So we will get the spike. The question is going to be, how big is it? I know people that have been traveling that have been in hell. So I'm sorry. It's definitely tough, but that's going to be an interesting one. And again, just kind of showing where we are. And then global flight schedules for the 12 weeks ahead, 0.9% lower. Number of passenger flights over the week of November 15th to 21st dropped 1%. So again, you're still seeing that softness in underlying demand. And it's just showing that even though planes are more crowded, there's still less planes. And that's something that I think is going to continue at least into next year. And then as the recession kind of gains steam, you'll likely see additional pressure to the downside, even as open table data shows things still remaining fairly elevated versus historics. And then you'll obviously get your drop for Thanksgiving, but not too much to show here. So that's what we have for you to wrap up the U.S. Demand. The next segment's going to go deeper into the global markets and some of the differential issues that we're seeing on how the physical market continues to weaken.